How many times turning on the TV, or scrolling through the various news offered by Google, have you come across cryptocurrency trading? A much discussed topic nowadays, having in mind that cryptocurrencies are no longer just a utopia, but are gradually conquering the market, attracting thousands of investors. However, let's not insert the fifth gear before we even start, as cryptocurrency trading is not the magic formula that will enable you to get rich in a few hours, as many mass media still keep repeating. Cryptocurrency trading is a real job, and as such it requires special skills and knowledge. Let's go through the subject together in a clear and no-nonsense way. What is cryptocurrency trading? When we talk about trading, we are referring to the online buying and selling of financial instruments, in this case cryptocurrencies, transactions carried out with the aim of making a profit. For example, if you had bought a large amount of Bitcoin 10 years ago, when the price of cryptocurrency was really very low, today through resale you could make a large profit. However, this is not the only way we can make money through cryptocurrency trading. We may also decide to convert our bitcoins into euros when a period of decline in the value of the latter begins, thus gaining a quantitative advantage. A good trader must be able to carefully study and analyze the market and its transformations over time before he or she starts putting his or her hand in his or her wallet. Indeed, it takes only a little to lose large amounts of money, accumulated perhaps over months and months of sacrifice. Cryptocurrency trading simply means buying and selling cryptocurrencies. Cryptocurrencies are an artificial entity that, unlike currencies with legal tender, i.e., currencies that have value in a particular state, are the result of an agreement that arises precisely from the exchange between legal tender and cryptocurrency. Most crypto arises through writing on the blockchain. This is not a central entity that is responsible for recording issues and who they belong to, but is a virtual ledger that is not located in a single place, but is spread across all nodes of the network and can be accessed simply by using the right protocol. On this registry at the moment are written the creations of new currency that the so-called miners make through mining. Through writing to the registry, the creation is certified and cryptocurrencies are deposited on wallets, which are electronic wallets on which one or more types of cryptocurrencies can be deposited. The mining operation is now performed only by companies set up for this type of operation, which have servers always on so that they are always connected and can be used and read. This and the energy expenditure required to support such an operation lead to these data warehouses being concentrated in areas where electricity is cheap. How cryptocurrency trading works. Cryptocurrency trading is divided into two techniques of action, each with its own characteristics and peculiarities. In the first place, we find cryptocurrency trading carried out with the help of derivative financial instruments, better known under the acronym CFD. This action technique does not focus on the purchase of any cryptocurrency, but rather involves speculation regarding market trends. If analyzing the market trend, the trader realizes that a considerable devaluation will soon occur, he will position himself short, speculating for the downside. Conversely, if the forecast implies favorable cryptocurrency growth over time, the trader will immediately position himself long. I cannot blame you. It seems like child's play to start investing and trading cryptocurrencies in this way. However, it is not at all. Behind a move lies entire months of studying and monitoring the market and the most influential companies. Not to mention the use of special trading platforms, which in the next paragraphs you will be made aware of. Cryptocurrency trading works similarly to trading any other currency. One currency is valued in relation to another, thus finding a parity. Compared to quotes in, for example, the eurodollar, the valuation of cryptocurrencies is much more volatile, partly because it is much more recent and not supported by the other forces that normally cause parities to shift between states. Thus there are no interest rates decided by central banks, inflation readings, speeches and public statements by political figures, etc. On what then is the exchange based? On investor sentiment, stock performance, rumors of new releases of other cryptocurrencies. This can be read in two diametrically opposed ways. On the one hand, one can assume that the absence of a real economy to which the cryptocurrency refers can mean a difficulty in understanding what the coin's quotation is, while on the other hand the quotation refers only to the graph and rumors within everyone's reach without secret news. Thus the launch of Facebook's coin, Libra, may have contributed to the decline in Bitcoin's quotation. Today it is Bitcoin that is the most stable cryptocurrency, some of which is beginning to be used in exchanges, although they are very marginal exchanges. There are beginning to be the first banks opening Bitcoin accounts and allowing people to easily exchange euros or dollars for Bitcoin and then withdraw from the same account through an ATM. It is not known whether it will come to an officialization of the cryptocurrency's role, and it is also not known whether this diffusion among financial institutions will lead to an increase in Bitcoin's value or to its decrease and the launch of other, more defunded cryptocurrencies. It is also not known what will happen when Zuckerberg actually succeeds in launching Libra, which will have a ready-made network around the world, and that is why the SEC, the US regulator, is holding it back. The added value of cryptos to the traditional monetary system lies in their cyber power, the blockchain, which is much more efficient than the funds transfer systems currently in use for other currencies precisely because it is widespread and, as a result, with which it is possible to take action and have the amount being transferred arrive in the recipient account within minutes. Certainly not having to go through a centralized system helps speed up movements, but will that be the way they will go as they lose domination by a central body? Adjustments will probably have to be made to achieve both at the same time. This may seem like a discussion that has little to do with cryptocurrency trading, but these are the most real issues to think about in order to understand the future of these currencies. Sometimes, in times of crisis, we hear that Bitcoin in particular is seen as a safe haven asset almost as comparable as gold was in the past. It may be a short-term solution, but to think what it may be like and whether it will still be there in 5 or 10 years is something that no one can know, whereas gold, which has been considered a currency of exchange since before the birth of Christ, is almost certain to retain its value and course. There is another issue that may work in Bitcoin's favor. Buying and selling and setting aside capital through Bitcoin has been stated by many to be a way to escape capital enforcement. The absence of the centralized system ensures that there is no entity that can get its hands on one's assets. Will the advent of banks in this sector change this situation? It will probably have repercussions. In what direction is yet to be determined. A new cryptocurrency could make its way in, perhaps referencing a different system if government and banking entities take over the blockchain. What is important to consider when approaching the world of cryptocurrencies is that we are dealing with a child and not an adult person, a child who is defining his personality and who is yet to discover how much strength he has to deal with life. Hence the wider fluctuations that exist in its course. What are the benefits and how much can be earned from cryptocurrency trading? In finance, risk is defined as the possibility of losing and gaining. The word, which in common parlance has a purely negative meaning, in the world of the financial market can be both positive and negative and becomes more synonymous with change. If we add the fact that there are instruments through which it is possible to earn by anticipating even a decrease in value and not only an increase, we easily come to the conclusion that in order to earn it is enough to be able to follow the fluctuations of the market. This is an advantage that one has with various financial instruments and not only with cryptocurrencies. The advantage of this type of currency is that since it is artificial and not real, its fluctuations are not based on difficult relationships that exist between GDP, monetary policy of states, supranational agreements, etc., but are simply the result of emotion and, to put it very simply, fads. This is an advantage for those with less economic training because at the very least it puts them on an equal footing with those who have studied in-depth relationships between macroeconomic quantities and fundamental analysis. Even more, it can put them at an advantage because those who are used to evaluating things with a certain form of reasoning will probably suffer an anchoring and will not be able to completely break away from this way of reasoning to follow new rules. How much can be gained then? It would be easy to say that in 2000 Bitcoin was worth €100 and in 2016 it was worth €18,000, so one could have turned each euro into €180 in just 16 years. One could have made much more money by following all the fluctuations and buying and selling at the right point, just as one could have made much less money by selling ahead of time because one had the feeling that it had reached its high point and perhaps by investing downward. How much can be gained is in our hands. Today it might be possible to achieve similar results with other cryptocurrencies, which today are trading between €100 and €200, and waiting for them to increase in value. This is a possible scenario, but not a certain one, and so we are in a risk scenario, also because it would tend to be a long-term investment and, however little, one would have to hold one's money steady and have the strength not to touch it for a long time. What types of cryptocurrency trading exist? Today mainly there are several ways to trade cryptocurrencies. The first is to buy the coin pure and simple and keep it in a wallet. The alternative is to buy a financial instrument that has a particular cryptocurrency as its underlying and hold or sell it in case of positive fluctuations. If you want to invest both upward and downward, you need to invest in a derivative. Today, with a little bit of the market, there are futures and options on Bitcoin, while as far as other cryptocurrencies are concerned one has to refer to CFDs. With the latter instruments one can create a portfolio that is also diversified among the different currencies available. In addition, through CFDs one can invest small amounts to play on daily or weekly fluctuations. The difference essentially to evaluate is this: if you want to create a safe in which to put a few euros, don't watch and wait for them to increase in value. You can think about taking coins directly into a wallet, keep the keys to access them and wait. This is the same approach as buying a work of art and then waiting for the artist to be recognized. It may go well and see one's purchase increase in value, or it may go unlisted and totally lose its value. With buying and selling CFDs, on the other hand, we are more in the realm of very short-term trading. These cannot be left idle without checking them, because of the leverage effect, one has to check whether the margin paid in is sufficient or not due to momentary situations. If you want to trade in this way, you have to take the activity you are going to do seriously, since the already wide swings of crypto are emphasized by the leverage of the CFD. The cryptocurrencies you can essentially trade on are Bitcoin, Litecoin, Ethereum, and Ripple. Bitcoin is the best known and became widespread due to the implementation of the blockchain in 2008 and is beginning to be used for real exchanges, although these are very marginal situations. Litecoin is a cryptocurrency born in 2011 from the idea of a former Google employee. Exchanges are based on peer-to-peer cryptography and it remains outside the control of any central authority. Compared to Bitcoin, it has a shorter time to trade and has been very successful in Finland. Ethereum was also born in 2011 and is considered technically superior to Bitcoin because it has introduced greater security in the blockchain and the unchangeability of contracts, as well as a higher speed than Bitcoin's. It is currently the second largest cryptocurrency only to Bitcoin. Ripple is a cryptocurrency created in 2013 and is based on a different system, as exchanges are centralized, hence its system is the one also used by financial systems for real-time exchanges of liquidity. The intent with its creation was also to lower fees and make it possible to trade currency in real time. Despite these features, it has remained a virtual currency and present only on the internet without having translated into prepaid cards as happened to Bitcoin. How to trade cryptocurrencies successfully strategies. Now that we have explained how cryptocurrency trading works and what action techniques professionals use to generate profit, you are most likely wondering how to start trading yourself. A reasonable question given the topic we are covering today, but one that we nevertheless need to address bit by bit. Trading is not just about turning on the computer and moving the mouse up and down for a few minutes, hoping to scrape something together. First of all, in order to trade you need to know the various platforms you can rely on, the rules imposed by them, but also the European regulation regarding cryptocurrency trading. In short, as you may have guessed, there are many factors that come into play, starting right from the brokers dedicated to cryptocurrency trading, each with different features and advantages. In order to trade crypto with a vision of short-term gains and not having to be a drawer trader, one must mainly turn to the world of CFDs. This way you can have, in addition to the already mentioned advantages of leverage, some other benefits to take into account. First among them is that the instruments are readily liquidatable at any time, being able to get back their value should one need to monetize the same money. In addition, several strategies can be implemented. There are first of all CFD zone strategies, limiting losses with stop losses, using trailing stops in case of positive movements according to the chosen direction, and one can also use pair trading using different cryptocurrencies. To use this method successfully, one must first study the trends of the various currencies. By viewing the chart, one will easily see how some are positively correlated, moving more or less in the same direction, while others take opposite values and trends. In this way, you will be able to determine how to pair trade so that you can make opposite trades on different cryptocurrencies that have similar trends, or the same type of trade direction on cryptocurrencies that have opposite trends. If you are uncertain how the trends will develop, you can use hedging, which, at least for the time being, is allowed in Europe. In the United States it is not, which consists of opening opposite direction positions on the same instrument. This does not mean that the two positions have to be opened at the same time, but you could decide to open a second position in the opposite direction to partially protect the first one at a loss and thus limit the damage, or conversely, open it when you are making a profit, thus creating the same effect as a trailing stop with two opposite positions. Whatever strategy you want to put in place, you cannot avoid an examination of the cryptocurrency's trend, observing its fluctuations, establishing supports and resistances both on a yearly, monthly, weekly and daily basis. This study will also depend on the type of trading you want to do, which in turn depends on the number of hours in which you can fairly actively monitor the relevant platform. There may be adjustments that need to be made. So if one spends many hours away from home, a necessary feature of the platform to choose on which to trade will be to have a good mobile system to lean on, one that is easily understood and convenient for making trades. This, in any case, will be the second feature, as the most important one remains the presence of tools on different cryptocurrencies, so that you will be ready to change strategy and currency should you deem it necessary. Where to trade cryptocurrencies? Best platforms. To trade we have to rely on the various specialized online platforms, also known as brokers. Theoretically it would also be possible to trade through one's own bank, However, it would just be a useless waste of money. In case you didn't know, banks are in the habit of imposing very high commissions for trades made by their clients, and as if that were not enough, they offer platforms for a fee. Online brokers, on the other hand, are free and impose significantly lower commissions, which will not take away half of your earnings. Trading platforms are designed to accompany the trader at all times of his or her day, which is why they are easily accessible by phone as well as computer. Having made this dutiful introduction in this regard, let us together take an in-depth look at each dedicated trading platform that you too can use to take your first steps into the world of cryptocurrencies.